Now, cost to cost method we are going to calculate. On January 1st, year one, a contractor agreed to build on the customer's land a bridge that is expected to complete on at the end of year three. So it's a 3-year contract. Clear. So the promised bridge is a single performance obligation and to be satisfied over the time. The contractor determines that the progress towards completion of the bridge is reasonably measurable using the input method based on the cost incurred. Clear? Input method is always on the basis of cost. Now, the contract price is for 2 million. The expected total cost of the project is 1.2 million. So there is a margin of 800,000, right? Now, what happens is in year one, cost incurred during each year, first year, it did 300,000 as expense. And total, how much should be the expense of this particular project? 1.2 million. So 900,000 he expects in the coming 2 years. Clear. So 300,000 is his out of pocket expense already. He have done. So how much percentage of the total cost he completed?
300 divided by 1.2.
Yeah. Okay. 25%, right? 25% he completed. So on the base of revenue also, he will consider the 25% of revenue. Got it? Now, by the end of year one, 25%, that is 300 divided by 1.2 million of the total expected cost have been incurred. Using the input method based on cost incurred, the contractor recognizes 25% of the total expected revenue as the revenue. Like 2 million is the contract price, right? And 25%, that means 500,000 is his sales. So cost of goods sold, he will consider as 300,000, what he spent already, right? So balance 200,000 is the gross profit for the first year. If he doesn't do this, what happens? If I'm running a company and this particular contract is the only contract I have, first 2 years I'll be showing loss.
Yeah, zero revenue.
Zero revenue, right? So to avoid that and to recognize some revenue, because my shareholders also will think, okay, what kind of company is this? They're not making any profit. And in addition to that, one more thing, for the tax authority, for the government, corporate taxes, they don't get any revenue, right, from my company. If I don't follow this standard, I recognize revenue only on the completion, then government is not getting any money. So they brought this rule. They should recognize revenue on this basis. Yeah. Right. Now, next, what happens? In year two, what happened? 300,000 he spent. Okay. And in the second year also, he spent additional 600,000. So 900,000 he already spent, and he expect, okay, 300,000 plus 600,000 he spent, and he expect, oh, sorry, one more zero, and he expect an additional expense. Additional is how much? 600,000, right? So ultimately, the cost of the project will be 1.5 million. Got it? So now, the second year, what we have to do is, he already spent 900,000. So 900,000, he was expecting a cost of 1.2 million. But when he reached the second year, he understood that, okay, cost will not be 1.2 million, it will be 1.5 million. Okay. Got it? Yeah. Because 900 already he spent, and he is expecting an additional 600,000. So 1.5 million. So how much percentage he completed is 900,000 divided by 60% is completed. Okay. Got it. And what is the revenue he's going to get? 2 million, right? 2 million. 2 millions, 60% he should recognize as revenue. Out of this, already he have recognized how much? 500,000. Correct. In the first year, he recognized 500,000, right? Now he can recognize only balance. So this minus 500,000 will give you 700,000. And what will be this year's profit?
Minus 600.
Yeah, minus 600. So 100,000 will be this year's profit, right? Sorry. Okay. 100,000 is the second year's profit. Got it? Solution. Okay. And in third year, what happens? How much is the cost? Additional cost? 550. So total cost of the project will be 3 plus 6 plus 5.5. Correct. So anyway, the project completes, right?
Yeah.
2 million. Is it zero is more? Right. 2 million minus how much is that? 100,000 plus 600,000 plus 150,000, right?
I think we need to move on because
Okay, that's minus. Yeah. Okay. Okay. So 550 will be profit. About this, how much you have recognized? The first year, how much you recognize? 200,000, right? First year you recognize 200,000. And in second year again 100,000 you recognized. Correct?
100,000.
Yeah, 100,000 you recognize. So 250 will be your current year profit. Got it? All good. Now, next comes output method. Output method recognizes revenue based on the direct measurement of the value of goods or services transferred to the customer to date relative, the remaining goods of services promised under the contract. Okay, how much you provided and how much is balance for you. However, revenue might not be recognized until a performance obligation is satisfied by transfer of control of goods or services by to the buyer. The effect is then that the revenue is recognized at a point in time, not over the time. The result is that same as under what was formerly known as completed contract method. Okay. Now, examples of unit method, output method includes appraisal of results achieved, milestones reached, units produced, or units delivered. Now, an entity may have a right to consideration from a customer in an amount corresponding directly to the value to the customer of performance to date. Using a practical expedite, revenue may be recognized as the amount to which the entity has a right to invoice the customer. Like sometimes there is you might invoice your customer on 50% completion or 75% completion. Yeah. Now, for example, yeah, output method, practical expedite. A law firm enters into a contract to provide consulting service to a customer for 1 year period for a fixed amount per hour of service provided. Because the customer simultaneously receives and consumes the benefits provided by the law firm's performance as it performs, revenue is recognized over time. Under the practical experience, the law firm may recognize revenue that it has a right to bill to the customer. Clear? Yeah. Next one. An entity recognizes revenue for a performance obligation satisfied over time only if the progress towards complete satisfaction of the performance obligation can be reasonably measured. Okay. However, revenue can be recognized to the extent of the cost incurred. It's zero profit margin when an entity is not able to reasonably measure the outcome of a performance obligation or its progress towards satisfaction of the obligation, but an entity expects to recover the cost incurred in satisfying the performance obligation. Like for example, if you take the example of the law firm also, that you entered into a contract with a client for 1 million, 100,000 dirhams contract for attending for a case in a labor court, and you are continuously providing service, and you don't know what will be the result. As you entered the contract, you said, okay, 100,000 dirhams fees plus out of pocket expense. This is your contract. So when the result comes, then they will pay you 100,000. Till that, whatever expense you had, you can recognize this as your revenue. Clear. That is in the case of law firm. And you can take this in the example of construction also. For example, you entered into a contract. For example, the same thing. Here is a same bridge contract. You don't know when you will finish because you are not expert in the bridge construction. You might take a lot of time, but you expect that the client will pay you the cost, whatever the cost. That case, you will recognize your revenue that will be equivalent to your cost. Now here, on January 1st, year one, Sadik company agrees to build on the customer's land a bridge that is expected to complete in the year three. The contract price is 2 million. The promised bridge is a single performance obligation to be satisfied over time. Because Sadik has no experience with the type of contract, it cannot reasonably estimate the total expected cost of the project. Accordingly, by the end of year one, progress towards completion of the bridge is not reasonably determinable. In year one, 300,000 of costs were incurred and paid by Sadik. So you are going to recognize revenue 300,000, accounts receivable 300,000, and revenue 300,000. And COGS 300 and cash 300,000. This 300,000 you might have paid in different times. Okay. Then, as soon as estimated loss on any project becomes apparent, it must be recognized in full, regardless of the methods used. Here, impairment and disposal of long lead assets. We might have discussed about fixed assets, right? Depreciation we discussed. We normally provide depreciation to assets, right? I hope you know. Right. So why do we provide depreciation? To recognize in a systematic way the wear and tear, the obsolescence of the machine, and to bring a fair value to the market price. Because when you purchase a machine for 100,000 and you never expect that you will sell it for 150,000 or 200,000 unless it is an antique piece, right? It's not an antique piece. If you're going to use it regularly, you will never get that amount. So you want to show in your books of account that the value which you're going to recognize. Sometimes what happens, even though if you provide depreciation, you can't match that price with the market price. You bought it for 100,000, you provide 20% depreciation. So first year, 80,000 is the value you're showing in your books. But for this particular machine, in the market, it is only 70,000. Or with this particular machine, you can generate only an income of 70,000. Then definitely the value of this machine is below than what you have shown in your books. So you have to recognize a loss. So this difference is called the impairment loss. Clear? Now, two-step impairment test. The two-step impairment test is applied to fixed assets and to intangible assets with finite useful life. Okay. Testing for impairment occurs when events or changes in circumstances indicate that the carrying amount of the asset may not be recoverable. For example, the market price has decreased significantly, or the use or physical condition of the asset has changed significantly and adversely. Clear? If this condition exists, then only you will check the impairment test. Clear? Now, The test for impairment has two steps. One is a recoverability test. That is the carrying amount of the long-lived asset to be held and used is not recoverable if it exceeds the sum of the undiscounted future cash flows expected from the use and disposal of the asset. Clear? For example, you run a rented car and you have a car which you give for rent. The car value in your books of account is 80,000. And if you rent it for next years also, you might get maximum 60,000. And you sell this car, you get additional 10,000. So maximum you can generate from this particular car is only 70,000. So there is a what we say recoverability test. You passed, you failed. This particular asset failed the recoverability test. You can't recover the value which is shown in the this books. Got it? iPhone? Okay. No. Then if the carrying amount is not recoverable, an impairment loss is recognized. Okay, that equals the excess of the carrying amount of the assets over its fair value. That means fair value minus the carrying amount. Carrying amount minus the fair value, the difference amount will be your loss. An impairment loss is recognized immediately in the income from continuing operations. Okay, and your entry will be impairment loss accountable to accumulated depreciation. Okay. So first you have to check the event or change in the circumstance. Maybe what happens like, yeah, there's a ban in plastic bags, right? Here in Abu Dhabi. So what if I'm running a company which manufacture plastic bags? Definitely my sales will go down. Okay. And my machines will not have that much use as before. So definitely this condition exists. So these companies have to pass a impairment loss. Correct. Now, when I check the event is there, now what I will do is I will check the undiscounted cash flow is more than carrying amount or not. If it is not more than carrying amount, then I have to recognize an impairment loss. What is the impairment loss? That is the carrying amount minus the fair value. Now, the carrying amount of a long-lived asset adjusted for an impairment loss is the new cost basis. Okay, a previously recognized impairment loss must not be reversed. According to US GAAP, you can't reverse any losses which you recognize. Got it? So same way, impairment loss also. And for the impairment loss, you will never recognize a loss unless otherwise it is a permanent loss, permanent change. Sometimes maybe because of 1 month, 2 month market crisis, you have a loss in the books, but you will not recognize. If it is a permanently loss, you will recognize. For example, the same case which I said for the plastic bag manufacturer. It is not going to change. This law is not going to change. Yeah.
It's like creating a provision, right?
No, actually not creating a provision. We are reducing the value from the books. Now, as I said for the car, 70,000 is now the market price and now the carrying amount. Next year, you will provide depreciation for 70,000, not for the 80,000, because you reduce the value of from 80,000 to 70,000 now. Got it?
You can increase them.
Yeah,
There is an increase them.
you will not reverse. According to US GAAP, you will not reverse. For example, after 2 years or next year, the asset had a market value now. Now you can sell it for 120,000, but you can't record in your books. If you can sell it for 120,000 and show it as your profit, but you can't appreciate your assets. Right. Under IFRS, you can appreciate. Clear? Here we have an example. On December 31st, year 2, a machine's carrying amount after the recognition of annual depreciation expenses, 160,000. Okay. 200,000 is the book value, historical cost, and 40,000 is the accumulated depreciation. So 160 is what you have. On the day, as a result of low demand for the company's product, management concluded that the carrying amount of the machine may not be recoverable. Okay. Management estimates that the undiscounted future cash flows over the remaining useful life of the machine is 150,000. Okay. On that day, the machine's estimated value is 136,000. Now, what happens? You're carrying your undiscounted future cash flow is 150 and your carrying amount is 160. So there is a loss. There's a difference. Now what you have to do is your book value is 160 and the fair value is 136. So difference 24,000 is your loss you have to recognize. So you will recognize an impairment loss, like impairment loss account up to accumulated depreciation 24,000. And in your balance sheet, this is how you will see cost of the machine 200,000, accumulated depreciation 40, 24,000 impairment loss. So 136 is here carrying over for the next year. Okay. Next. Disposal of long-lived assets. Okay. When you sell your asset, normally when you sell, you will either recognize a gain on disposal or loss on disposal. So when you remove an asset from your books of goods, you will have to not only the carrying cost, historical value, you have to remove the depreciation also, accumulated depreciation also. No. When an item of PP is sold, the gain or loss of disposal is the difference between the net proceedings and the carrying amount of the asset. Okay, depreciation is recognized to the date of sale. Like for example, we normally provide depreciation yearly, right? For example, we are selling this particular asset on August 15. So these days, January to August 15, the depreciation you have to provide before you sell. You record the sale entry. Yeah. Then okay, remove the carrying amount is removed from the books. The proceedings are recorded and any gain or losses is recognized. For example, here, a company sold a machine carrying 100,000 carrying cost. That means historical cost is 180 and 80 is the accumulated depreciation. They sold it for 135. So cash is 135 and you have to credit your machine 180 and you have to debit your accumulated depreciation because accumulated depreciation is having a credit balance. So you are debiting. Then the difference is your gain on disposal. Okay. For the loss also the same way. You're getting 90,000. Anyway, you will cancel your accumulated depreciation and machine. So the difference is the 10,000 loss on disposal. Yeah, this chapter is all. Any doubts? All good?
Yes.
No, no. Okay. Yeah. Thank you, Rinzin.
It's finished.